market movers. This is The Pulse with Francine Lacqua.
Well, good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London. Now, President Trump says he has decided on his pick for the next Fed chair, who he expects to deliver interest rate cuts. Now, sources have told Bloomberg that Trump's chief economic advisor, Kevin Hassett, is seen as the likely choice to succeed the current Fed chief, Jay Powell.
Fed chair, are you any closer on that right now?
I know who I'm going to pick. Yeah.
Oh, tell us.
Kevin Hassett.
I'm not telling you.
Wildly exciting. Now, traders still betting on a rate cut by the Fed in December, but the month is beginning with a risk-off mood ahead of quite a lot of U.S. economic data this week. So let's discuss all of this with Sam Lynton-Brown, head of global macro strategy at BNP Paribas Markets 360, Bloomberg's Markets Today co-editor Marina Konyama, and our Daybreak editor Mark Perrier. It's exciting. It's Monday. We have news. We don't know the news, but we know there's a pick and it's been made. Mark, what do we know about the next Fed chair?
Well, everyone is certainly excited about who it's going to be, with Trump saying yesterday he's made his choice. And we've reported that Kevin Hassett is seen as a likely successor to Jerome Powell. But again, it's very much a wait and see game until the decision is actually made.
Yeah, I mean, is there a chance that he doesn't get confirmed? So this is a tricky with being a Fed chair, is that you have to be maybe loyal to this president if you want the job, but then you have to be 100% independent, otherwise you don't get confirmed.
There's always a chance he may not be confirmed, but obviously, as we've reported, he does share the views of lower rates, the need for lower rates, which the president obviously is very much in favor of. But again, it's a tough balancing act, and it remains to be seen if he'll be chosen.
Sam, your thoughts? First of all, Fed cut in December. And good morning.
Good morning.
We're getting straight to it this Monday morning.
Fed cut in December. We think Powell wants to cut, and we think he has the votes. The key point, though, and I think this very much interacts with the debate around the next Fed chair, is we think that takes policy to a neutral level. So our estimate of where neutral rates in the US is much higher than where the Fed thinks it is. So we'd be a little bit more cautious on the degree to which they cut after this.
Yeah, because the situation gets a lot more complicated.
Once the Fed brings policy to where they no longer see it as restrictive for the economy, what we expect to see is that the data recovers. So thus far, the market's been a bit concerned about the soft patch we're seeing in the US economy at the moment. We think that primarily reflects a delayed impact from the trade uncertainty earlier this year. But then as we go into next year, we'll see some of a recovery. If that's associated as well with an expectation that Fed policy is now in a pretty good place, it means we only expect the Fed to cut rates once more in March.
So, Sam, I mean, overall, you think that basically what we have now is policy that's much more accommodative than perceived?
Or less restrictive than perceived.
Less restrictive. What are you looking at, Marina?
Well, actually, you're just talking about the Fed, and I think what's quite interesting, as we are expecting to, have that confirmed, who will be the new Fed chair. As you said, there's that expectation now that there will be a rate cut in December. But I think what Sam was saying about actually that then taking it perhaps to a neutral policy rate is quite interesting if we're looking at what the market is pricing in now. So whilst we have recently had an increase in those bets for a December cut, there's not a huge amount of change this morning. But what we are seeing is looking ahead into next year, actually a slight pairing of those bets now. So that I think that very much ties in with what Sam was saying. And of course, we have an enormous amount of economic data coming in the next few days and this week from the US. And so I think that will also give us a better picture of actually where the economy is and perhaps, where that need is for Fed policy, beyond the actual political impetus.
Sam, I mean, I guess the point is how much of it will be on data or how much of it is on actually who becomes the next, Fed president?
The market, to some extent, has interpreted it, the latest news flow around Hassett, as discounting more cuts in the second half of 2026 and also in 2027. So the market is interpreting the news flow as consistent with a few more rate cuts. I think what's key, though, is what happens with the economy. So if what we see heading into next year is that right now is a soft patch on growth, next year we're growing in line with trend, but inflation is actually quite sticky, perhaps more around 3%. It's going to be quite difficult, we'd argue, for significantly more rate cuts.
Mark, how much do we know about what Kevin Hassett thinks, on inflation, on growth, and actually what the Fed should do?
He is, as we've reported, he sides with lower interest rates. But obviously, he has to be very careful. He has to remain objective and project that. He's been, especially yesterday, he appeared on Face the Nation, very balanced in his way of speaking, but obviously noting that Americans would love lower car payments. Who wouldn't, right? So, it's a balancing act going into this.
Do you see some more risks to inflation towards the middle of next year?
Yes. Is the easy answer. Yes, we do. I think there's a few elements to this. The first is if one believes, as we do, that the US economy is going to be growing in line with trend next year, that implies the current soft patch in data is just a soft patch. The downside risks the market's nervous about in the labour market don't eventually materialise. The second element is monetary policy. So if one believes that monetary policy is less restrictive now than the Fed, because neutral rates are higher than the Fed says they are, and one believes that the Fed are easing a little bit more dovish than they otherwise would to take out some of the political pressure, take out some of the heat from Washington, then it means that you create an upside risk to inflation because monetary policy becomes too accommodative given how the economy is actually doing.
Merwin, when you look at the markets globally, they've latched on so much, and actually the Fed expectations that maybe they've let to one side some of these still inflation risks out there, but also some of the debt concerns.
Yeah, I think that's certainly possible because there has been this sort of politicization of everything, and we are still expecting a lot of data, as we've already said. And I think we have to remember as well, when we're looking at the broader market, if we're looking across equities as well, today we're seeing this huge, risk-off sentiment returning. This isn't new. We've seen this coming back with sort of increasing frequency, over the last few weeks, and there does seem to be some concern there. And I think ultimately what the Fed does is also going to play into that, because if there isn't the amount of dovishness that perhaps has been expected, that poses another risk for that equity rally as well.
In terms of, Mark, of when Kevin Hassett, are we expecting a kind of imminent... we have the decision, or so the president says that he has a decision, but when are we going to find out?
I'm not exactly sure, actually, if we've reported on that, if there's a decision coming up. But with Trump, these things can move quite rapidly. But I suspect that, we will probably have a clear indication as the holidays approach.
And then when does Chair Powell actually leave? He's still a Fed governor, which he hasn't said that he'll fully leave that
in
post.
The course of next year.
So in the course...
Yes.
What else are we looking at? I know we spent a lot of time talking about the UK budget last week, which was... it got a lot of people, or certainly it wasn't seen as fair by a lot of people, is how I would put it. 6 days afterwards, what's your take?
Bearish currency. We think that the rally in the pound that we had before the budget was a short squeeze, but the medium-term picture, we think, for the pound is not a good one. There's two elements to it. One is political uncertainty. The market needs to price a bit of a political tail that is a downside risk for the pound. And the second is Bank of England. We think the market should price lower terminal policy rates from the Bank of England. Right now, the market's only expecting 2 more cuts. We think it's likely we'll get those 2 cuts December and then early next year, but that then the risk into 2027 is they cut rates twice more. For bonds, the picture's quite different, though. We actually like duration in the UK compared to some of the other markets, which I believe is quite out of consensus. The element here is that lower terminal rates should support fixed income, and supply in the UK, we expect next year to fall perhaps as much as 50 billion, which is a lot for the UK. It's about 20%. Yeah. So you have lower terminal Bank of England expectations accompanied with lower supply. It can support UK duration on a cross market, for example, against Germany, who we think are going to be doing massive fiscal, more than the market expects next year.
So where'd you buy into? Are you buying bonds?
We'd buy bonds 10-year versus Germany, and we'd receive the front end of the UK curve as well.
What's the markets telling us about the UK today, Molina?
Well, today things are not looking great on the equities front, although actually the FTSE 100 is doing better than other European stocks, which is often the case when there's a kind of broader risk-off mood. But looking at the pound, I think, to Sam's point, we have seen some weakness. We're falling again a bit closer towards $1.32. And that does seem to me to imply that there's just a lack of enthusiasm from the budget. There's no real sort of upward driver, and that is, we're seeing the pound the worst performing, G10 currency today. So there's that, and then also in the gilt market, yields are actually a bit higher across the curve, but that is also in line with what's happening in the rest of Europe. But I think, longer term, we did see the 30-year yield coming down quite a lot after the budget, and I think that does definitely play into the messaging of the budget, which was, OK, they've sort of shored up the fiscal balance sheet for the government, but there's not really a huge amount of growth that's being built in there. So there's not a lot for the currency. There is that stability that the gilt market wanted to see. And I think that with today's sort of morning reaction put aside, that is what we're seeing starting to come through in the markets. But there is a lot of uncertainty because it's quite a sort of niggly budget to properly digest.
Yeah, and I think the Prime Minister's also speaking a little bit later on, so we'll see what Keir Starmer has to say about that. Look, I keep on hearing ECB officials saying, interest rates are fine where they are. It doesn't give us a great kind of indication of where they think they will go. And it's also things move all the time. So for me, it's a rather odd statement saying rates are where they need to be now.
I see what you mean. We agree, though. Rates are in a good place right now. The key point, though, I'd make is we think the next move from the ECB will be a hike, not a cut. That's quite different to market pricing. Now, the hike
everybody sit down.
The hike isn't going to come quickly. We think it's a 2027 story. But the key here I'd make is European growth next year can surprise materially on the upside. The market's expecting growth of about 1%. We think it will be 1.5%. And the key driver here is German fiscal expectations. The market still remains very sceptical that we're going to see the amount of fiscal delivered, that the fiscal is going to be delivered on time, and that it's going to be effective when it is delivered. We think some of those concerns are fair, but overall the picture is more positive than perceived. So stronger German growth can drive stronger European growth, and in turn an ECB hike.
OK, that is definitely like an outlier call. I want to ask you about AI valuations in a second, but Bitcoin, is it just a risk move, or is there something fundamentally worrying Bitcoin believers?
Well, we have seen it drop about 5% this morning, and that is filtering through to all major tokens. So there's definitely a risk-off move this morning, and that is something we often see particularly amplified in cryptocurrencies. They do really sort of move as a risk asset. I think the fact we'll be watching what happens in tech. Particularly the US markets. Obviously, we had a very sort of slow Friday after things are closed on Thanksgiving Thursday, so it's perhaps a little bit too early to completely read into the trends there because there has been an unusual amount of volume. But I think there is that real risk-off mood, and there's just been such a sort of long tailwind into it that there is some risk there to probably be unwound. But it really probably depends on what happens with the Fed, as we've been saying, in terms of whether there's that impetus for more of a sort of rally into the year end, whether we see that Santa rally in equities. And I think Bitcoin's all part of that picture at the moment.
I imagine AI is left, right and centre of that rally or not. Your take on AI valuations?
I think into the end of the year, it makes sense that we see some of the most consensus and popular positions pare back. We saw that in October with gold. We've seen that in November with tech/AI-linked names. Our view is that heading into next year, the theme is very much still it's a buying opportunity. So our view is that the sell-off we've seen is first and foremost a reflection of positioning. Right. Our metrics, our quantitative proprietary metrics we run at BNP Paribas, suggest now that the position is actually quite clean. Yep. The market has not re-risked despite the bounce in prices. And so we think there's plenty of scope for a year-end rally.
OK, wonderful. Thank you all for joining us. Sam Lynton-Brown from BNP Paribas Markets 360, Bloomberg's Morena Konyam and Mark Perrier. Coming up, airlines scramble to avoid disruption to travel schedules as they urgently update software on their Airbus A320 jets. We'll have more on that next. And this is Bloomberg.
We had a great Treasury auction, interest rates went down. And so I think that the American people could expect President Trump to pick somebody who's going to help them, have cheaper car loans and easier access to mortgages at lower rates. And that's what we saw in the market response.
Kevin Hassett, speaking to CBS, faced the nation on Sunday with the White House economic director now seemingly in line to be President Trump's choice to replace Jay Powell as Fed chair. Now, global airlines are beginning to report that they've completed an Airbus software update that grounded flights on the weekend. This morning, the French aircraft manufacturer says a, quote, vast majority of its roughly 6,000 A320 jets have been modified. Well, we're joined by Bloomberg's managing editor for space and aviation, Benedict Kamel. Benny, thank you. What's been the impact of Airbus's largest recall?
So the impact appears to have been fairly limited, and that's actually quite fortunate, because when this announcement came on Friday night, it did look like this could turn into a real sort of cosmic storm. The announcement from Airbus being that about 6,000 of its A320 family aircraft would need a software revision, essentially reverting to an older version of software in the cockpit, because they had found that there was some sort of radiation interference that made the current software unsafe to use. So over the weekend, a mad scramble from Airbus, but also obviously airline customers around the world, trying to sort of address this fix. And as you said, we heard this morning from Airbus that the very vast majority of these planes, so almost 6,000, have indeed now been upgraded. Only fewer than 100 still need the fix. So it does seem like they have a good handle on the issue. The stock is down a smidge. I do think people are a little bit spooked by what happened there. But given the scale of this, it seems like they really managed to get a handle on it fairly swiftly.
What triggered the need for this urgent software update?
So that part was left a little bit opaque. Airbus initially came out with a release on Friday night saying that there had been a recent incident whereby this solar radiation had impacted flight controls. We then had to sort of backtrace what that incident might have been, and we learned that there was an incident in late October involving a JetBlue aircraft where there was a sudden sort of downward pitch of the plane because of computer inputs that the pilot couldn't control. Nobody was seriously hurt in that incident, but it was obviously something that spooked the pilot, led to a diversion of the plane, and ultimately led to where we ended up over the weekend, which was the software needs to be changed, needs to go back to a previous version, and hopefully that will have fixed the problem.
This fault, Benny, comes as Airbus tries to meet ambitious delivery targets. So what are the implications for the company?
Well, given the speed at which they've managed to address the issue, it seems like there won't be any lasting impact. Had this dragged out, shall we say, into the week or even into the latter part of the month, that would have been a very different conversation. But right now, it seems like they can essentially move on from this scare over the weekend and really focus on what they need to do, which is build planes. And they still have quite a few to make. They have an ambitious target for the end of the year, which is 820 aircraft deliveries, and they're still some ways off from making that. So really the focus has to be on that, and had this software issue turn into a longer lasting problem for them, that would certainly have diverted management and also engineering resources, and that could have potentially jeopardized that goal. But as I said, given how swiftly they got a handle on it and how few planes still need the upgrade, it seems like this cosmic storm, as it were, has blown over.
Benny, thank you so much. Benny Kamel there with the very latest, of course, on Airbus. Now, oil trading higher today after OPEC Plus confirmed it will stick with plans to pause production hikes during the first quarter of 2026. Traders also factoring in geopolitical uncertainty stemming from U.S. President Trump saying Venezuelan airspace should be considered closed. Now, for more, let's bring in Bloomberg's EMEA News Director, Will Kennedy. Will, as always, thank you so much for joining us. So what's behind OPEC's decision to pause output?
Good morning, Francine. Well, we expected this. They'd signal it a month earlier, that after a year of gently putting more oil into the market to make sure that they could maintain their market share, the risks of a continued prolonged oversupply in 2026 meant that they should probably pause production increases, and that's what they reaffirmed in their latest monthly meeting yesterday. I don't think it changes the big picture hugely, which is that most people still expect a significant supply overhang next year, but prices have actually held up reasonably well in the last few days, partly because of OPEC, but partly because of broader geopolitical risks.
Well, what has been the impact of President Trump saying that basically Venezuela's airspace is closed and then downplaying those comments?
Yes, I think this is a long-running thing that people got their eye on tensions in Venezuela. Has been a very big oil exporting nation. Its oil industry is a a shadow of its former self, but it still exports almost 1 million barrels of oil a day. And a conflict there or regime change there would throw those exports into jeopardy. The other geopolitical situation that people are watching is actually in the Black Sea, where Ukraine appears to have done two things in recent days. One, attack a pair of tankers linked to Russia's Shadow Fleet in the Black Sea. But they've also successfully struck the loading terminal for the BTC pipeline, which brings all of Kazakhstan's oil to the Black Sea. And it looks like there may be some long-term damage there. So you put all of these situations together, and geopolitical tensions globally are counterbalancing that big picture of oversupply that I described earlier.
Well, talk to me about copper and silver. We looked at silver futures for the first time in ages on right at the top of the show. So what's pushing them higher?
Yep. Both at records this morning. Copper is a very interesting one, obviously a vital material to the global economy, where people have been painting quite a bullish picture for a long time now. We've got a strong demand picture overall, driven by the use of copper in electrification and everything from grids to data centers to electric cars. At the same time, we've seen several mining companies say that their production is not going to be as strong as expected, and so you've got that supply-demand balance looking quite bullish, but people are also very focused on tariffs in the US. There haven't been tariffs on copper yet, but they're still looking at it, and prices in the US are higher than the rest of the world, so that's sucking in a lot of copper, giving less copper for consumers in places like China.
Well, worst case scenario, could we actually see a supply crunch? I mean, do we have enough of this stuff?
Well, we will have as much as we have, and the economy will work. I mean, people are bullish about this. We had the head of copper trading at Mercuria, one of the world's best-known copper traders, saying that this is a once in a generation opportunity to trade copper higher because of all these factors. But as always, the cure for a boom is a boom, and that people will find ways to use less copper, to substitute copper, to do things a different way. But well, you can use you can recycle. You can recycle. There's huge amounts of copper to recycle. You can use aluminium instead in some instances. Okay. There are other things you can do. But yes, I think that the consensus is that this is a pretty bullish outlook for this metal, and hence a record this morning.
Well, thank you so much, as ever, Will Kennedy there, Bloomberg's EMEA news director. Now, cryptocurrencies falling sharply, bringing fresh momentum to a wide-ranging sell-off that appeared to have settled. The crypto market is on shaky ground after a weeks-long sell-off that began when some $19 billion in levered bets were wiped out in early October, just days after Bitcoin set an all-time high of 126,251. Coming up, Ukraine's president calls for a fair and lasting peace as talks on the U.S.-led peace plan advance. We'll have the details next, and this is Bloomberg. Good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London, and these are your top stories. President Trump says he's decided who will be the next chair of the Federal Reserve, but will not announce it just yet. He's expected to name his nominee before Christmas. Cryptocurrencies fall sharply in a risk-off start to December, Bitcoin falling below $86,000 at one point. Plus, a U.S. Special Envoy, Steve Witkoff, is set to meet with Putin on Tuesday. That's according to state media, while Ukraine's President Zelensky is due to arrive in Paris as talks advance on the U.S.-led peace plan. So let's stick with that story and the ongoing negotiations to end the war in Ukraine. At the weekend, there were talks between the U.S. and Ukrainian negotiators which were described as productive. But the U.S. Secretary of State Marco Rubio says there was no breakthrough.
It's not just about the terms that ends fighting. It's about also the terms that set up Ukraine for long-term prosperity. I thought we started laying the groundwork for that, most certainly in Geneva. I think we continued that work in our communications throughout the week. I think we built on that again today, but there's more work to be done. This is delicate. It's complicated. There are a lot of moving parts, and obviously there's another party involved here that'll have to be a part of the equation, and that'll continue later this week when Mr. Witkoff travels to Moscow.
Now, for more on this, Bloomberg's chief Europe correspondent, Oliver Crook, joins us from Brussels. Ollie, good morning. So what's the latest from these U.S.-Ukrainian talks?
Yeah, Francine, after this sort of firing shot was fired a week and a half ago when we got that 28-point plan out of Washington, D.C., and then it was now redacted and changed into that 19-point plan after those Geneva talks, that further negotiations took place yesterday in Florida, led by Secretary of State Marco Rubio and the Ukrainian delegation, failing to break through to the sort of final text of what this arrangement could look like. And we have to say that ever since that 28-point plan exploded very publicly on the public stage, those conversations have gone very much underground. So it's very hard to get a reading right now to see if they have bridged those pretty large differences that there were between the Ukrainian conception, the American conception, and the Russian conception of what a peace proposal could look like. We're still dealing with a lot of the thorniest issues, whether it's territorial concessions, whether it's a question of security guarantees. These are still sort of major questions, and we don't know how much progress has been made. That being said, the focus this week follows swiftly onto diplomacy. Today, Volodymyr Zelensky, president of Ukraine, will be in Paris to meet with Emmanuel Macron. We understand Steve Witkoff could leave as early as today to go to Russia to have those talks, as you were saying, Francine, tomorrow with Vladimir Putin. And then we have Marco Rubio, who's coming to Brussels a little later this week for a meeting of NATO foreign ministers here in Brussels, hopefully for the Europeans to get their voice heard in what they want to see in terms of the defense architecture going forward in any kind of arrangement between the Ukrainians and the Russians, because, of course, this also includes the Europeans. That being said, Francine, we're also expecting Vladimir Putin to go to India a little bit later this week. So does that sound like somebody who believes that there is a moment of crunch talks to really get a deal over the line over the next couple of days? Perhaps not, but those are the state of play as we enter this week, which will be sort of a very rich one in terms of diplomacy over the next few days.
Yeah, Ollie, looking at all the flags behind you, it's also the EU defense ministers meeting in Brussels. What can we expect from that?
Yeah, that's right. They've just filed in. They're having their meeting today. A number of different European defense ministers. There were a few comments coming in, really basically repeating the things we've heard from them from the very beginning, saying that there will be no decision about Ukraine without Ukraine, that the European voice also needs to be heard. But as we know, Francine, there's been a lot of difficulty getting that European voice heard because they have sort of failed to act on some of the many issues that they actually are able to act on. For one thing, there are those frozen Russian assets. Over the last few days, there has been no progress in that particular regard. In fact, the Belgians, who really hold the key to unlocking that 140 billion euros worth of assets that the Russians have being held in Belgium here, that reparations loans that would be held against that, they have dug in, saying that basically this may not be the time to touch those assets. This may not be the time for that conversation because they may derail peace talks. You add to that the fact that Viktor Orban spent his weekend in Moscow alongside Vladimir Putin to discuss oil and gas, again, sending a fairly negative signal from the Europeans here who have failed to sort of get to the negotiating table through any sort of activity of their own, but again, saying sort of those reassuring remarks. We do expect the Ukrainian defense minister to also attend this meeting, so we'll see what they have to say in a couple hours' time when they break up.
Ollie, thanks so much. Our chief Europe correspondent, Oliver Crook. Now, for more on this, we're joined by Timothy Ash, senior EM sovereign strategist at RBC BlueBay Asset Management, and Stephanie Baker, Bloomberg's senior writer and also the author of Punishing Putin. Stephanie, let's start with you. I mean, this goes really to the very heart of what your book is about. It's trying to find an economic arrangement that suits everyone in all of this. What do we know about these Ukrainian peace talks? Are we close?
We don't know that much of the detail from the talks yesterday, but I think what is emerging are four key sticking points here. One is the issue of territory, whether or not Ukraine will give up territory that Russia has not been able to conquer militarily. There's the issue of Ukraine's possible NATO membership, the kind of language around that, whether or not that is ruled out as a possibility. Sovereign frozen Russian assets and the fate of those. as well as any kind of security guarantees provided by European countries for Ukraine in the case of a deal. And I think that the two sides are very far apart on those issues. Putin last week gave a very bellicose speech, actually, vowing to fight until the last Ukrainian soldier dies. So I don't think he has given up his maximalist goals here. At the same time, Ukraine is in a weakened position because of this corruption scandal that has ensnared several individuals in Zelensky's orbit, although not Zelensky himself. And I think that is putting them under intense pressure to do a deal.
Tim, what do you think Vladimir Putin is ready to give up on now, if anything?
Well, look, as Stephanie mentioned, I mean, Putin's still got his maximalist goal. He wants a bad peace deal for Ukraine, right? He wants a deal that makes Ukraine not sustainable. Putin wants the whole of Ukraine. I mean, I think that's absolutely crystal clear. He wants strategic control of the country. I think he would accept a deal that he thought, was not sustainable for Ukrainian context. And I think a deal imposed on Zelensky without adequate security guarantees, whether, if there's some de facto loss of territory, but without really very strong security guarantees, I mean, Ukraine would not really have a very strong future in that scenario, right? There'd be a risk of political and social instability. The country's economic outlook would be pretty dismal. There wouldn't be any foreign investment into the country. So again, Ukraine would kind of struggle economically. All those migrants wouldn't come back. Maybe many people further would leave. And that's exactly what Putin wants. So he's kind of playing a game here, I think, with the American negotiators to make sure, he enforces a poisoned chalice on Zelensky, if anything.
Yeah. But so, Tim, how likely is Ukraine to concede these territories? And actually, does Volodymyr Zelensky actually have a choice?
I think it's impossible that Zelensky will accept de jure the legal loss of any territory. Ukraine's territorial integrity is enshrined in the Constitution. I can't imagine a scenario where the Ukrainian Rada would vote for the legal loss of territory. De facto, I mean, accepting the front lines where they are, I mean, I think Ukrainians could accept that. They think that perhaps in the future there'll be negotiations about the long-term status. But key, as I mentioned, if even de facto Ukraine accepts the loss of the territory, is the rest of the country has to be secure enough that it has a future and it can progress. And I think that's related to security assurances. If it's not NATO, there should be State of Israel-style security assurances that Ukraine will be given the types of military kit to be able to defend itself. I think EU accession, a firm anchor of EU accession, is really, really important in terms of Ukraine's economic development. And I think the 28-point plan, it wasn't very strong in there. It was almost that there's a potential for Ukraine to be in the EU. I think the Ukrainians want something firmer than a date. And then, as mentioned by Stephanie, in terms of the immobilized Russian assets, I mean, Ukraine has suffered $1 trillion damage. Who's going to pay for recovery and reconstruction? $330 billion of CBR assets would help. They would help anchor that recovery and reconstruction. So, I mean, they're the kind of issues that are at hand in these negotiations. And I don't think Zelensky will give way unless he feels pretty sure about, those three items, essentially.
Yeah. Stephanie, I mean, this feels like a bad deal for Ukraine unless there are security guarantees and maybe some of the money that Tim is talking about. Why is the U.S. pushing this on Ukraine?
I think Trump wants a deal, and he doesn't care terribly whether or not it's a bad deal for Ukraine or whether it sticks for the long haul. There's a lot of money at stake here, and I think that's one of the key parts of the negotiation that we don't really have much visibility into. But the proposed 28-point plan included the idea of using some of those frozen Russian assets to rebuild Ukraine, but the profits going back to the U.S. And I think that's one driving force behind that kind of a deal. I think Putin is, potentially leaving his options open opportunistically. Perhaps he might see doing a deal on his own terms might be advantageous, especially if it involves sanctions relief, because the sanctions on Russian oil are hurting, and that pressure will only mount as time goes on. But the idea of handing over territory in Europe to the aggressor is monumental. I mean, to just, I think Tim was right. I think that's going to be impossible for the Ukrainians to accept, for any Ukrainian politician to accept, because I don't think there's support for that within Ukraine.
So then what happens? And I know one thing that I keep on hearing quite a lot of people talking about, a possible regime change in Ukraine because of the scandal. I mean, you've always said it's impossible to organize elections in an active war.
Well, this is the other point that the Ukrainians are pushing back on. Putin wants elections to be held within 100 days in Ukraine. Ukraine says that's unrealistic. There's a war going on. Even if there is a ceasefire that's agreed relatively soon, it would take an enormous amount of time and effort to organize elections. How do you organize elections and votes on the front line? What happens to those contested territories? And it would, of course, be subjected to massive Russian interference, as we've seen with Russian interference with elections across Europe. I think that there would be a double-down Russian effort to try to ensure that Zelensky does not get reelected. So it would be very hard to ensure free and fair elections. It would take months to organize.
Tim, I know the crucial component that's missing from this is Europe, who's still trying to get involved. We know that President Zelensky is meeting with Macron in France today. What's their role in this, in supporting the reconstruction of Ukraine?
Well, just to add to what Stephanie already said, I mean, the Helsinki Final Act from 1975, European countries, including the former Soviet Union, agreed not to change each other's borders by force, and the borders as were at the end of the Second World War would remain in place. And I think for Europe, with so many territorial issues between countries, I mean, it's a disaster for Europe if as part of this deal, Ukraine's borders are changed. I mean, but you're right. I mean, Europe is desperately trying to get its place in this negotiation to support Ukraine. I mean, to simplify things, I think after J.D. Vance's appearance at the Munich Security Conference in February, it was crystal clear to Europe that the US backstop for Europe is not there. And actually their security is massively under threat because they see there's this existential threat from Russia. The Europeans don't believe that Putin will stop in Ukraine. They think he has malign intentions towards Europe. And actually the key to Europe's defense is two things. One, it's Ukraine holding out as long as possible so Europe can build its autonomous defense capability separate from the Americans, and secondly, that the Americans continue to sell weapons to Europe and Ukraine so they can hold out. Europe needs to be a bit cleverer. It has agency. It's going to be a huge purchase of US weapons. It should let the Americans know that, if the Americans want Europe to be an ally in terms of the long-term hegemonic battle with China, the Europeans need to say, well, China is existential threat to you. It's your number one national security threat. It's not ours. Russia is. Help us sort Russia out. Help us secure our security. And then we will be good future allies to you in whatever you're thinking on China. And we need to bang that line pretty aggressively. And as already mentioned on the immobilized Russian assets, we've messed around for 3.5 years. I mean, people like me have been arguing this should have been done. And we're now in this desperate situation where Ukraine runs out of money next year. There's a huge financing gap. The IMF suggested $140 billion of shortfall to their program to 29. The Europeans have argued in the broader funding envelope for Ukraine, which is military and defense, it's 140 billion euros for the period 26 and 27. Unless we use immobilized Russian assets, where is the money going to come from? It will come from European taxpayers or Ukraine fails. If Ukraine is not funded, it loses the war. That's an absolute disaster for Europe. You think of Ukraine probably will collapse, failed state, millions of Ukrainians moving west, Russia on our border, massive increase in defense spending, probably going to go from $2 to $5 to $1 trillion of extra defense spending. So Europe's in a real mess about this. But what it does know, it has to support Ukraine to buy time for Europe to get its act together. It has to somehow work with the Americans to continue to get those arms supplies.
Tim, so many questions that we'll try and answer over the course of the next couple of weeks. Tim Ash, Senior EM Sovereign Strategist at RBC BlueBay Asset Management, our very own senior writer, Stephanie Baker. Now to some other stories making news today. And Switzerland has voted to reject a 50% inheritance tax on super-rich residents after wealthy entrepreneurs threatened to leave the country. The left-wing Young Socialist group launched the proposal as a way of raising funds to fight climate change. But the plan ran into staunch opposition from the government and all parties aside from the left. Now, Chinese car makers lost ground in Europe in October, slipping back from the record market share they captured a month earlier across the region. In the hybrid categories, where manufacturers like BYD have been on a tear, their share as a group fell around 3 percentage points to 12.6% from September's peak. That's according to researcher Dataforce. Now, new EV registrations, a core category for Chinese brands, declined to 11.8% to 12.6%. And the Apollo chief executive said last week that people have lost their minds and become hysterical about private credit, dismissing the idea it could pose a systemic risk. Paul Davies from Bloomberg Opinion says the story is a bit more complicated and the hysteria will get very real in the near future. Well, luckily enough, we have Paul joining me in the studio today. It's almost as if we planned it. Paul, thanks so much for being with us. So the Apollo chief executive really downplaying some of the risks. Are they just talking their own book? What are you seeing?
I think they're on the defensive in a lot of ways. It's not just Mark Rowan of Apollo. We had the co-CEO of Blue Owl Capital saying similar things, the week before as well, about how most investors were really quite delusional about the risks involved in private credit. I think there's a confluence of things going on here. One of it is when we talk about private credit, historically what we've mostly meant is direct lending to kind of mid-market companies, which are smaller companies, which is, speculative grade or junk rated, a lot of it, and that increasingly became basically a private version of LBO financing. We know this is kind of riskier debt. Defaults there have been very low, but they are starting to climb. And also the more important thing is what we call selective defaults, which is, where companies move their debt to payment in kind. Well, either they stop paying over cash or they just kind of extend duration without offering investors any sort of compensation. These things are starting to climb a lot more as well. And they're not as high as they were last year, but, they're getting closer to the range that they were in 2020. And what people like, Mark Rowan especially is talking about is he's trying to kind of draw us away from that, because what they do is a lot more investment grade stuff, which is meant to be, debt that is well designed to suit the regulatory capital requirements of their insurance companies.
But so when you look at the outlook for example, for repayment problems or even bankruptcies, what do they look like? Do they accelerate into next year?
It's definitely going to get worse next year. So Goldman Sachs Asset Management, in a report about 2026 of last week, I think, we're talking about how there's sort of 15% of these companies in the US who are unable to cover their interest payments from their operating profits, which is, EBITDA. So that is not a good place to be in. These companies are kind of, on the edge of stress. They're having to do things like, move to payment in kind. And interest rates will help there a little bit, but it's not going to solve all those problems. So some of these companies are going to hit a sort of a reckoning. And KBRA, one of the ratings agencies, or not agencies, companies we call them nowadays, also warned last week that they have a record number of companies that they monitor in this space who are, the lowest rating possible, CCC-, which means your kind of next step default, unless you have some kind of cash injection to help you recover or your business to improve significantly.
Paul, there's a lot to get through. Thank you so much for joining us. Paul Davies with a fabulous, opinion piece that he also wrote today. Paul Davies of Bloomberg Opinion. Now, coming up, signs of consumer resilience as Black Friday sales rise in the U.S. We'll dig into that next, and this is Bloomberg. Cryptocurrencies falling sharply, with Bitcoin sliding as much as 6% after a weeks-long sell-off. Anna Herrera, Bloomberg senior crypto editor, joins us now. So, Anna, thank you for joining us. What's behind the fall?
So, as usual, we've been saying for the last week, what's different in this crypto crash is that there doesn't seem to be like a very clear sign of why prices are falling. Before, we had all these big collapses, whereas now it tends to be following more the general macro environment and what other more riskier assets do. For example, today, we saw Asian stocks are falling off of what's happening in Japan, and there seems to be a parallel with crypto now.
So does it continue on this downward spiral?
It's hard to say. We thought last week that maybe we'd hit sort of the ceiling now, the bottom, rather the floor rather than the ceiling, but you never know. It's a new day. What tends to happen sometimes is we see when the U.S. day opens that there's another sort of slide again. So I guess we have to watch. And investors are also looking at the Fed, see what's going to happen there. So it's turned into a kind of a regular sort of risk asset, less fun than it was before, I guess.
And very quickly, is there a psychological level?
I think the last was below 82%, 82,000. I think was the last. So I guess if it falls beyond that and then 70, then maybe it'll keep falling. And as you know, with crypto, the exchanges have these auto liquidations. So when there's a big pronounced crash, it goes even more.
Anna, thank you so much, as ever. Bloomberg senior crypto editor Anna Herrera. Now, Cyber Monday, talking about psychology, is underway after sales climbed on Black Friday, a sign that consumers are also continuing to spend despite economic concerns. Now, for more, we're joined by Bloomberg Opinion columnist Andrea Felsted. Andrea, how did we spend on Black Friday? A lot.
Yes, it's up. Things like electronics, clothing, toys. The headlines do look like it's up, but you've got to take inflation into account, so the volume of goods bought won't be quite as spectacular as the headline numbers. It'll be also interesting to dig a bit deeper into what people actually bought. Now, in Prime Day in July, I know that's a different time of year, coming up to back to school, now we're into the holidays. What we saw was that people bought things they needed, so they stocked up on things like household essentials, back to school products. That's different to sort of treating yourself. The consumer is very focused on value, so they're looking to get the best deals on the things they buy all the time rather than spoiling themselves.
Andrea, turning out to your piece today, which is a great read, what makes you think Gen Z will put on a Cartier in their basket instead of a Rolex?
They just seem to love the brand. And, Cartier has done a really good job in targeting them. Remember a decade ago when all the girls were stacking their love bracelets? We had pictures of the Kardashians in these bracelets that were very difficult to get off. Cartier really saw that, and they leaned into that with really effective marketing, effective ambassadors. Timothée Chalamet wearing a smaller watch than is typical for a man. That has all gone into this zeitgeist of smaller, often gold, often rectangular watches, which plays exactly into Cartier's strength.
I love that, which also means a lower price point, given the price of gold is going up.
Exactly, right. Although the other thing that Richemont have been very good at, not just in the watches, but across the jewellery brands, is ensuring there are some entry-level prices, and you can buy a mini steel Panthère for about £3,500. That's the same as mini handbags. So this is why jewellery, and in this case these watches, have outperformed leather goods, where price rises have been astronomical, and consumers are saying, is this bag really worth it?
Andrea, what's the role of AI playing in this consumer spending?
Well, we are seeing consumers use AI-enabled search to try and get the best deal. We've also seen some evidence they're actually using AI agents to buy, and that creates a new sort of question for retailers and brands, because for forever they've been targeting people in their advertising and search. Now they've got to target these agents. So I should think by next Black Friday there'll be a lot of thinking in how do we show up in these searches.
Andrea, thank you so much. Andrea Felsted there from Bloomberg Opinion. Now, just a redhead, which means it's big news, crossing the Bloomberg terminal. China's Vanke, the distressed builder that surprised markets last week when it proposed an unspecified delay in paying a local bond, has now asked holders to wait a year to be made whole as it faces mounting liquidity pressure amid waning state support. Now, the president of Shopify is on Bloomberg Tech at 4:30 p.m. London time. Great person to speak to on this Cyber Monday. Now, up next, Bloomberg Brief, the full roundup of the main stories today, including Donald Trump saying he's finally made his decision on a replacement for Jay Powell. This is Bloomberg.